Our guest this week is Niki Scevak of Blackbird Ventures. Niki's a co-founder of Blackbird, which is the largest venture firm in Australia, and has backed massive winners such as Canva, Zoox, and CultureAmp, among others. We talk about how world-beating companies can come from anywhere in the world, including outside Silicon Valley, how Blackbird goes to great lengths to give feedback to founders they pass on, and why Niki is extremely excited about AI applications. Please enjoy. Niki, thanks for coming on the show.
Thank you for having me.
So Blackbird is massive in Australia and New Zealand. A lot of American listeners may not be as familiar despite that. So maybe just to get things rolling, would you please tell folks about Blackbird?
Yeah, we founded Blackbird 12 years ago with the idea that generational companies could come from Australia. I think it's hard to imagine, but back then people thought you could only build a company in Silicon Valley. Venture capitalists on Sand Hill Road had a rule that they had to be within cycling distance of each company that they invested in. And the belief at Blackbird was that these world-beating champion companies could come from anywhere in the world, in particular to come from Australia. Also back then in Australia, there were surprisingly a lot of successful startups. There was Atlassian, there was probably 24 more, WiseTech, Campaign Monitor, Redbubble, Aconex, Half-Brick Studios, so the list goes on, of companies worth hundreds of millions, if not billions in the case of Atlassian. And so you had successful startups, but you had no investors focusing on them in the early stages. You had growth stage investors, and in particular, Accel did a wonderful job in sort of sweeping the market and skimming the cream of the crop, and was fortunate to invest in 5 Australian companies and headlined by Atlassian. But at the growth stage, at the sort of 8 or 10 years into a company's journey when they were profitable and growing, and so on and so forth. So the situation back then was successful startups, but no real successful investors looking at them. And we thought if there was some capital at the beginning, and if there was some community. The other strange thing was that the magic of Silicon Valley, which is founders helping founders, someone builds a company and invests and helps the next generation, that was largely absent in Australia at the time. And so with Blackbird and with our first fund, it was a collection of successful technology founders who were pulling the capital, but also dedicating their time to help the next generation. And so the first fund was 29 million Aussie, which is about $20 million USD, and was incredibly hard to raise. Took us 2 years, took us 500 meetings to get 96 people to say yes. So you can do the math and realize that it's sort of 100K, 200K at a time per yes. So hard to start, but of course, because it was so hard to raise our fund, it was the best time to have a fund in the market, and we were fortunate to invest in Canva and Safety Culture, CultureAmp, Zoox, which is a robotaxi company acquired by Amazon.
Were those all in Fund 1?
Yeah. And not only did we invest in the first rounds of those companies, we ended up investing in every round of each of them. And the second big sort of realization at Blackbird and came with our second fund was why would we invest just before we knew a company was successful, and then as soon as we knew it was successful, we would stop investing. And so from our second fund onwards, we raised kind of 2 pools of capital. One is an early stage fund that invests in all the new companies we meet, and then a follow-on fund that is a pool of capital dedicated to the current portfolio and the best opportunities within that set of companies. And so, for instance, in Canva's case, we invested $250,000 in the seed round, but we invested $270 million over the company's life. And a similar story with CultureAmp and Zoox and Safety Culture and Eucalyptus and a number of other companies that we've been fortunate to invest in. The idea of starting a relationship right at the beginning, but investing all through its life, and particularly to focus again on those companies with the potential to be a generational company. And we've really oriented all that we do at Blackbird around that power law concept. And then another major moment came in 2019 when we set up our New Zealand office and formed a dedicated New Zealand fund. We saw all of the same attributes in New Zealand as we saw in Australia a few years beforehand, and you had great startups, you had amazing founders, you had sort of no one looking at the early stages. They were global people that would invest after a company was successful, but no real funds and community dedicated to helping a company before they were successful.
Having multiple unicorns, or at least close enough acorns, Canva, out of a first fund, I don't think most people listening would just realize how statistically extremely unlikely that is. Do you look back on that fund one and it's a mix of we picked the right moment, picked very well, there's some luck, and there's some great execution? Like, how do you think about that mix of ingredients?
Yeah, that's
with such a
that's all very accurate. The other element I would overlay is back in 2012, venture capital outside of the US was very skewed to sort of take a good idea from the US and make it work in another part of the world. And Rocket Internet being the prototypical example of that. And you can be very successful doing that. So it's not like it's a bad strategy, but a very different kind of company is one that is founded anywhere in the world, but is trying to be the best in the world. They're not trying to be the best they're not the best in Australia, they're the best in the world. And so at Blackbird, we had a particular passion, and the idea of Blackbird itself was formed around this particular kind of company that wanted to be the best in the world, that could be global from day one. And also, I think there's PLG and all of the playbooks and knowledge and so on. But back in 2012, Atlassian was really the pioneer of PLG. It wasn't called PLG at the time, and obviously Dropbox and Slack and a few others really took it to great heights. But Atlassian, which was founded in 2002, Jira, which is their flagship product, was founded in 2004. It was built with this product-led growth personality, and we were very much in love with that type of product, that type of company when we founded Blackbird. And I think the downside of Australia is that it's a horrible time zone for everywhere else in the world. The good thing about Australia is it's a horrible time zone everywhere in the world, and so you had to sell without a salesperson, and you had to then let the product be the salesperson. And I think that sort of strong personality within most software companies in Australia has contributed again to one of the best cohorts of software companies, and the extreme successes of Atlassian and Canva in particular.
Blackbird has 16 investors on the website, which seems pretty massive for the scope of Australia and New Zealand. And just for folks who aren't as in the weeds with this, A16Z's got 100 and based in a country that's 13x the population. So you cover all the beaches, it would seem like, around the country. How much of the strategy today is around wanting to see everything coming through Australia and New Zealand?
We are obsessed with seeing every single company right at the beginning, before they have revenue, before they have a product. And there's a Slack channel in Blackbird Slack called See All the Seeds, and we obsess over whether we did get the opportunity to say yes or no to a company at their first round of capital, and whether we didn't, and why we didn't, and to correct that mistake very quickly. I think, again, it's the hardest form of investing. Like, if you invest when there's nothing, when there's not even a product or revenue, that's by definition the hardest moment in time to make a correct decision about the startup's future. However, if you do take on that problem, and if you do a relatively good job investing right at the beginning, it's such a special place to begin building a relationship. And I always liken it to, you'll always remember, there's like, I'm sure, one high school teacher who had an outsized impact on your you're thinking in your life. There's probably someone early in your career that took a chance on you that you will never forget, and will always hold that in a special place in your heart. And so investing right at the beginning occupies that same special place. And so if you start there, if you build a great relationship, then you can invest hundreds of millions of dollars into the generational companies, which is ultimately the most financially lucrative thing you can ever do. So it's very difficult because you have to start at the beginning. But if you do it, you have that relationship is going to outcompete any global brand or global investor in those moments. And so if you can do it well, it's an incredibly powerful business model. Obviously, it's very difficult, and in particular, I would say in Australia and New Zealand, from when we started out, we're helping to build the ecosystem. We're helping to tend to the garden, to allow the flowers to bloom. Versus, I think in Silicon Valley, you have the luxury of all of the salmon are swimming down the river, and you're sort of trying to pick. It's all happening regardless of anything that you need to do. And so I think we've always been very almost like taking on that responsibility of hopefully helping to create the ecosystem that we would love to see. And if we do a great job, again, hopefully we'll get the chance to invest in the best companies that get started out of that activity. And if we do, we'll get the chance to invest hundreds of millions of dollars into those ones that do succeed.
Well, the humility that goes with that of getting a chance to invest with them. I won't pin you down on exactly what your win rate looks like when you're trying to get into companies. But I would assume it's extraordinarily high given the many things you bring to the table as far as background, track record, community, platform, all the things that you guys have accomplished. It feels like you're a very logical firm that anyone at pre-seed seed would be tripping over to be working with. On the rare time where you get a thanks but no thanks from founders, what is the reason that they'll typically give you?
A few sort of context remarks and then directly answer your question. In Australia, there isn't very many people dedicated to the early stages. Even now, there's a community of angels, maybe a dozen smaller funds, 4 larger funds, but it's still very uncompetitive overall. The global firms, US firms, did come down to Australia and New Zealand in COVID and invest pre-seed seed, but that activity has largely retreated to the Series A and onward stage, which it was also before COVID. In terms of, and also if you invest right at the beginning before product and before revenue, again, that's a uncompetitive stage. It's not like people love that. No traction isn't great. Again, I want to sort of emphasize uncompetitive overall. If we do get into a competitive situation, I would say it's in a sort of pedigreed founder. And what I mean by that is, if Stripe and Coinbase and Airbnb are sort of the equivalents in the US of like I was a product manager at Stripe and now I'm doing a startup and, lots of people are going to be interested in that person. We are seeing alumni of Canva and Atlassian and newer companies like Eucalyptus and Dovetail. And so where you have pedigreed founders, you're more likely to have competition. And in those situations, it might be what I'm trying to think, sort of a reason for a no. We don't tend to lose on valuation. Again, Blackbird will happily pay the highest price of people. It might be, again, it all comes down to human relationships. So in specific cases, that person might just have a stronger relationship with that other investor or have worked with them in the past, or I think it sort of comes down to relationships. And again, at the specific case-by-case level, we can definitely lose out in some cases because of that.
Maybe to invert the question common debate that I've seen on Twitter and on LinkedIn lately among VCs and founders is about giving feedback to founders. And you've got different schools of thought where some VCs will try to be very transparent, sometimes at the risk of really upsetting founders. And then you'll have some VCs who somewhat cynically say, I just don't give feedback because sometimes someone will take what I said and run with it and be extremely negative, and it's bad for my brand. Curious your view of feedback, how you give feedback at Blackbird, and kind of how you think about it across the industry.
100% on the former. I think any highly intelligent, high performance person seeks out feedback, wants to improve every day. And so with the feedback we give, and particularly in the negative case, we try to make it very specific. So first of all, there are certain phrases that you can never say at Blackbird in terms of for a no. So you can never say you're a bit too early, come back to us, next round or something like that. That is an outlaw. Again, as we've just discussed, the job of Blackbird is to invest in the very first round before revenue, before product. So we will never ever say it's too early. And then people are always I'm like some version of I'm uncertain about the future, or the future is uncertain. Like that is, of course, the future is uncertain, and that again, that's just a silly category of feedback. So when we have an entrepreneur pitch, the team, we all fill out a sort of survey of how much we liked it, like hell yes, yes, no, hell no, reasons why we liked it, reasons why we didn't. And so in each feedback email, the lead investor who's leading the process will actually even take raw quotes from that body of feedback and include it in the email, structure it up to say, we hate this type of customer, or we didn't believe the product was 10x better. I don't know. We thought it was a dumb idea to spend money on marketing when you've grown, I don't know, organically, or whatever the specific level of feedback. And I think if you have specific negative feedback, it actually does open the door to the future. So I think the flip side of your comment is like, I want to keep in touch with the person and maybe they'll succeed, and maybe and so I want to keep my options open. But if you give them negative specific feedback can be proven or disproven. So you can sort of say, I don't believe that I don't know, certain type of customer will say yes within a 90-day sales cycle. And so if you say that, the person can come back to you and say, well, we started selling and we've got, it's flying off the shelves and people are saying yes within 14 days. And, the central IT department's not getting involved, and it's a one-person decision and they're paying $1,000 a user a month. And so you can have specific conversations about specific feedback. And so, again, the person can come back and say, hey, here's a reason for you to change your mind because you've given them specific feedback, versus the general one. People don't really respect that. I don't find anyway. And then the other important thing to understand is all of the best founders are their own worst critic. And so inside of their head is a dark space of like harsh feedback. And so whatever harsh feedback you think you're giving them, it's nothing compared to the harsh feedback they're giving themselves. And so again, there's almost like this relief or this joy in response to negative feedback, because the voice in their head is so much more negative than the feedback that you've given them. And again, you have to do it with a sense of empathy. You have to do it from a place of love. If you don't get that balance right, again, that can go the wrong way. But again, if you have it with that empathetic, coming from an empathetic place, coming from a loving sense of improvement, I find that negative feedback, people love it rather than people hate it.
I love that. I think that's fantastic. What do you think is the biggest misconception about Australian startups?
I think people think of it as like the minor leagues, or like it's not a developed ecosystem, or people are going to struggle to raise capital, or I don't know. It's not. It's like I think in an American sense, people have a hard time thinking about anything outside of America. But I think the game has changed from the point of view that it's the Olympics now. It's like every country competing for the gold medals in these different categories. And even though, you know, USA can come at the top of the medal table, like they don't win the majority of the medals, and they don't have gold medals in every race. And so I think just like Australia did really well in the Paris Games and came fourth overall in the whole world, despite having 25 million people live here. I think sort of people underestimate that all of the best companies are coming from outside of Silicon Valley. And I think even unicorn is like this. You can be a unicorn if you raise $1 billion. But I think if you look at the output of success of what really matters and the $100 billion companies, and you have to say like it's like Shopify, it's Atlassian, it's Spotify, and those are not even from America, let alone from Silicon Valley, that have been the successful ones over the past decade. And you get lots of so the less dollars and all the winners, like that's I think that's outside of America, not inside of America. Over the last 10 years, obviously the next 10 years can be different.
Yeah. I mean, I think there is just generally more of an emphasis on, to your point around capital efficiency. You didn't put it exactly that way, but I think there's a lot to that. I mean, in my time in Australia, I was there for many years and invested in growth companies in Australia and abroad, and just consistently the companies there were still very focused with big goals and ambitions, but being a lot more thoughtful about not necessarily having artisanal bacon served to their developers every morning at breakfast. It was a lot more pragmatic about how we can take capital we have and grow at the fastest rates possible within reason, and having solid unit economics. I mean, looking back on Afterpay's expansion in the US, instead of going whole hog with it, they found a US venture firm to help fund part of it, essentially had a free kick, and turned out to be a pretty valuable kick. So,
yep. But I would draw that lesson to all businesses. Like if you look at the best of the best, Microsoft never needed to raise money. They did raise one venture round, but that felt like a guilt-tripped round where they were like, you need to have expertise on your board, versus like they didn't. They were super, super profitable from the beginning. Google again raised a Series A from Sequoia and Kleiner, but didn't touch the $25 million. And Google was pumping out cash from day one. And so again, like all of the best tend to be, these dream stories of successful from the beginning. There's no hero's journey. There's no like, oh my God, these existential moments, and it's really difficult, and we needed to pivot. And like a lot of the successes are just successes from the start. And so I think people also memorialize, difficulty, where actually, if you look at the world, and mostly success was success from the start. And of course, a lot of those founders will create the hero's journey, and will create the hero's journey of these crucible moments. But on the whole, comparing it to the experience of the companies that had all of these real difficulties, it seems like just a success from the beginning.
What is your temperature with AI today? When I talk to a lot of investors, they kind of skew towards one of really excited or feeling it's overcooked. Are you one of those, somewhere between, further out?
And I would summarize it as, you got the App Store moment a couple of years ago with ChatGPT and OpenAI, but now you're getting the application wave of, you'll get the Uber and the Airbnb and the DoorDash and the Instagram and the whatever mobile application rose up because of the release of the App Store. You're getting the same in business software with AI at its core, and I think like AI application companies are just growing faster than any other software company that I've ever seen. we have sort of like an internal benchmarking where it's like, oh, this company is growing faster than Canva, which we were like, oh my God, that's like the most amazing thing and first time in history. But then there's like 5 companies that have grown faster than Canva in our realm to 5 million ARR, 10 million ARR. It's just insane how fast the companies are growing. And then you then ask why they're growing so fast. And I think with AI application software, you just have this extreme pricing for a sort of per user per month basis. So where a traditional software company might charge $30 a seat per month, even Google Workspace, where you get Gmail and everything else for $5 a user a month, AI application software companies, some of them are charging like $300 a user a month or $1,000 a user a month. And so $1,000 versus like $30, it's like a 30x increase in per user per month pricing. And so they're perhaps signing up the same raw volume of companies and the raw volume of seats, but the price per seat is just so extremely high. And because the products are so magical, because the products unleash this burst of productivity. And then I think another underestimated quality is a lot of these products are just taking away the most hated part of a person's job of, an example is doctors and AI transcription. And if you're going to see patients all through the day, and then at the end of the day, you're going to have a couple hours to go through the admin and the referral letters and the prescription notices and the health record and the health insurance processing. And so if AI can delete the last couple hours of the day, they go home earlier, they get rid of the most hated part of their day. And so the willingness to pay of that doctor is so extreme. And normally, like if a couple of years ago without AI, someone comes to us and says, hey, we're doing some software for doctors, like, oh, that's like the worst software category ever. They never buy anything. The hospitals don't even have internet and going to interfere with the procurement process and, HIPAA compliance. But it's like AI, knife through butter, extreme user per month pricing. It's astounding. So extremely exciting. On the flip side, you have extreme churn. So churn rates of AI application companies are way higher. Why might that be? It could be that they're charging too much and they just need to figure out the right pricing and the right willingness to pay. It could be that, your first version is always the most embarrassing version. If you quickly iterate on the product and you quickly build more and more value into it, the value equals the price and churn goes down. It could be, a lot of these are starting with individual use cases, and as soon as you get someone into a team and then inviting the teammates, churn goes down. All of these things could be true. It could be just they're experimenting. So churn rate, and then also the best traction in the world. If you look at these categories, there's like you're looking at this single company, but then you're looking at 5 other companies. They've all got exactly the same world's best traction curves. And so the level of extreme competition, which all markets, you let the 1,000 flowers bloom in the beginning, the race narrows, the big tech companies enter into the second phase, the race narrows again. Like that's a natural evolution of how every market gets built. But the weird thing, or the strange, unique thing, is every single company seems to have the world-beating traction. Usually, that's like very clear who's winning, who's losing in other areas of software categories. But with AI, it's just like, wow, everyone grew from 0 to 10 million ARR in a couple of years, which again makes it so fascinating. I don't know how it will end up, and I don't know how things resolve and so on. But it's such an exciting time to be investing, I think, in particular in AI application companies, and just I think also if you're a venture capitalist, you're investing in products, and so you're in many ways a connoisseur of products, and in particular the magical nature of products at the moment is just such a joy to behold. So super excited. Again, with all of those specific sort of elements of context.
To go back to a couple of things you said around churn and, first version's your worst version. I have seen plenty of startups come through where when I kick the tires on the first version, they're out, products live. Traction can be solid early, but churn can be pretty high for a lot of the reasons you hinted at. I'm curious, when you're looking at some of these where you know that, or, let me take this one again. I've looked at a lot of startups recently where, and to get back to your point on churn and, the first version of the product is the worst. It feels like the AI underpinning the product isn't quite there as far as delivering a truly um, mainstream experience. Like early adopters would run with the product, but as far as solving a problem for a doctor, they need something that's going to be real, accurate far more than what I see from a lot of these companies today. And I try and balance, and I'd love to hear your perspective on this, knowing that the capability behind that is not far away because of the pace that AI models and LLMs are progressing. It's such a steep rate of change, but with the product not probably quite being there today. Like if the product just stopped cold with where it is, it's not going to be able to fill what the market needs. I'm curious, when you see that kind of push and pull, how do you think about something like that?
I think, especially early on, everything you take, you can't take a point in time. You have to sort of look at the velocity of progress. You have to look at the acceleration of progress, and you have to graph everything on a time axis. And so, I think the specific judgment is like, is it imminent? Like, is it a pretty good product, or is it a magical product? But there's just a bit too much sort of Wizard of Oz in the background and no gross margin because of the Wizard of Oz human element in the background. And then you sort of believe in, can it change? And obviously in venture capital, there's a very specific framework and structure of timing. You get 18 to 24 months to make a unit of progress. So I think, again, in that sort of timing or judging of inflection points, you're sort of putting it on that timeline. And so the other difficult thing is it's so hard to think exponentially that it's not like, again, like your imagination, my imagination of GPT-5 is so likely to be underestimating the reality of GPT-5 because you're thinking, oh yeah, like it will get better, but like it could get 100x better, or it could get 10x better, or it could get 2x better. It's I've been so it's almost like the mistakes have been not positive enough on that achievement curve and that progress curve of some of the LLMs, and then just the cost as well. Like oftentimes, if you can do so much more in terms of personalization and tuning and not building your own models, but like there's levels of like tuning, there's levels of reweighting, there's different levels of model development to your own specific use case that I think people are still trapped in this. Oh, it costs $5 billion to build a model, when if you look at the last couple of months, like I think Anthropic lowered their prices by 50x in the last couple of months. And so again, you have to sort of build in that curve of it's just getting so much cheaper and so much better. That's again part of the excitement of the industry. So typically, again, getting the wrong timing is the same as being wrong in the venture capital sort of saying. And so I think you're specifically judging it. Will it be game changing within 18 to 24 months?
How are you thinking about seed valuations overall today?
It feels like it's returned to pre-COVID levels. I think don't appreciate that valuation is a journey of education that I think the whole industry has been on for 50 years. And even there's always like this bias to think that the valuation at some point in the past was the right valuation. And so when people say, Dropbox raised it at 2 million pre, or Instagram raised it at 2 million pre, Airbnb raised it at 3 million pre, I think we can categorically say that they were the wrong seed round valuations. They should have been much higher, knowing that what was possible in terms of the successful version of a startup, 10 or 15 years later, and what valuation it would achieve. And then also back then, companies like Google and Microsoft and Apple were 100 or 200 billion, not 3 trillion. And so again, people have really underestimated how big the successful companies can get at the end of the rainbow. Again, startups, you have 5,000 start whatever every year, and then the most valuable one and what it's worth in 10 or 15 years time, that's essentially what determines the correct valuation of a startup. You've got a 1 in 5,000 chance of it being worth $100 billion, and then therefore whatever the math works out at. So I think in COVID, on the other side, 100 million pre for an idea stage white paper crypto company, dumb idea. All of the rounds that got funded, the most valuable one didn't justify paying 100 million pre for the idea stage round of a white paper crypto company. And so somewhere in the middle, it shouldn't be 2 or 3 pre, it shouldn't be 100 pre. It should be somewhere in between those goalposts. I think in Australia, so from our 2018 fund to our 2020 fund, valuations tripled. However, valuations have gone down by half in our 2022 fund. So it's still more than 2018, but it's way less than the 2020 fund. All things being equal, but all things aren't equal. You have AI application companies that are growing faster than any other company that was seen so far in our 12 years of Blackbird. So that's probably too cheap, not too expensive. And then valuations are also the byproduct of competition on the supply side of capital, and a lot less people are raising money. A lot more people are raising half as much money for their fund as they thought they might do in Australia and New Zealand specifically. You can have local investors and you can have US global investors. Now you really only have Australian and New Zealand investors at the really early stages. So there's a supply and demand of capital. There's just how much money people have, and overall, I think venture capital, the fixed variable, tends to be the percentage of ownership. So if you have $2 to spend, you're going to get call it 20% for that $2, which means it's a $10 million valuation. If you have $1 to spend, you'll get 20%, which means it's $5 million valuation. So whatever you have tends to get 20% on another way to think about valuations, which again doesn't reflect the ultimate outcome, but the ultimate outcome is so uncertain. And if you look back at the last 20 years, people have been way underestimating the outcome of the $3 trillion Magnificent Seven companies or the $100 billion plus rapidly growing startups that get spat out 10 years later.
Yeah. On underestimating outcomes, something you've mentioned publicly in the past is you have super funds as clients, and correct me if I somehow got that incorrect, but it's interesting. Australian venture, obviously, in the grand scheme of things, is pretty young. I mean, venture at large is a young asset class, but particularly in Australia, where you guys essentially pioneered the fund model there. How early is it with institutional capital going into venture in Australia today?
I think that's been another huge part of Blackbird's story, and we would not have been possible without the superannuation industry overall, and then also the choices of say about half a dozen of them to support Blackbird at a very early stage and throughout every stage thereafter. And for the listeners, the Australian superannuation industry is our version of the pension fund industry, but where in the US your 401k is a voluntary contribution that people make. In Australia, it's a mandatory contribution, and every person in Australia contributes 10%. Actually, I think it's more, maybe 11 or 12% of their salary into their superannuation fund. So you have this huge influx of capital every single month as 11 or 12% of everyone's salary goes into the fund. The funds themselves too tend to grow as the investment performance grows. And so you have a sort of rich, diversified industry of about 12 to 20 funds that are all, getting to sovereign wealth fund sized funds. And I think it's only continuing to compound. For instance, one, which is Host Plus, first invested in Blackbird in 2015. I think they were about $15 billion Aussie dollar size in 2015. 9 years later, they're more than $100 billion. And you can go fund by fund through our LP base, and they've all grown like startups at hundreds of billions of dollars of funds under management scale. And so I would say that's been a competitive advantage of Blackbird is the superannuation system in Australia. You compare that to the traditional funders of American venture capital, which are endowments and foundations. They're not growing, and they have to give away 5% of their total fund to fund the operations of the charity or the university. And in the case of universities, they've had a really tough time through COVID and international students and so on and so forth. So it's you have a pool of capital that is either flat or down, and then you have a pool of capital that is large and growing like a startup. It's such a stark contrast to the mood of those LPs. And so I think Blackbird wouldn't be possible without those superannuation funds, and the superannuation funds wouldn't be possible without this Australian government vision and foresight in the 80s that's now created, I think what every other country around the world is thinking, wow, that's amazing. So I think Australia is in a very good position overall because of the superannuation system and the venture capital industry, and Blackbird in particular. Again, it's been an essential part of our story.
You mentioned earlier people who might be inspired by a teacher they had or an early mentor in their career who really helped lift them forward. Maybe just to wrap things up, is there anyone that you could think of from your own personal experience who's just played a big role early in your life career that helped bring you to where you are today?
Yeah, the high school version of that is a maths teacher that I had. I would say like I was a complete nerd as a kid and loved computers and loved math. And his name was Mr. Lund. I went from sort of being okay liking maths to taking on the most advanced maths and coming top of the class and so on and so forth. So I think again that unlock, you never forget it. And in my career, I would say I've been very fortunate to be born in the same year as Mike Cannon-Brookes, who went to university in the same course in the same school, and so we got to know each other, roommates, friends, and he's been obviously an incredible mentor, as inspiration as he's built Atlassian, personal supporter through his investments in our funds and Blackbird itself. And so that the lottery of life, I'd say, to be able to grow up alongside him has also been that special person for me.
Awesome. Well, that's great, Niki. This has been a really fun conversation. I'd love to learn more about what you're building, where you've been, and you guys have been just a fantastic success story. So thanks for coming on and sharing a lot of the lessons and insights.
Thanks for having me.
Hi, Joe again. Thanks for watching the show. If you'd like more of this in the future, subscribe to our channel. If you'd like to learn more about Seaplane Ventures, just check out seaplaneventures.com. Cheers.